Hi, my name is Adam Clavelle, and this is my financial analysis Bloomberg project for Finance 451. And for starters, I analyzed two separate industries with two different approaches: food and beverage industry. I kind of ran their ratios uh, bit by bit. I didn't go too into depth at once with each company. Uh, I organized it by ratios. For the retail industry, I just broke down each company. But here we go. We're going to start with the adult beverage industry and their short-term liquidity. The current ratio of the past 5 years, Craft Brew Alliance has been rising. This can signal inefficiency of assets, and when we subtract inventory, we get the quick ratio, and we see that that's rising as well. Now, a large difference between the quick and cash ratio signals that the company operates heavily with inventory to run their business. And when we subtract inventory from the current ratio, we see half the company's assets are sunk in inventory, at least their current assets. But similar results are expected with other companies in the presentation, at least in this industry. As a whole, it runs off of raw materials, which is included in inventory. So from looking at the liquidity ratios, you can see that in short run, the company can pay its bills with some efficiency, but the current ratio rises, above 2.0. And in 2017, that just raises concern in terms of asset efficiency, but it falls back down to 1.5 in the last trailing 12 months of 2018. So here we go, on to liquidity ratios for Boston. Boston Beer Company seems to be able to be paying their bills in the short run. They keep their current ratio between 1.5 and 2, and this is a good indication of asset efficiency, but the high amount of cash on hand raises concern, of course. 2016 cash ratio rose to 0.9. So right off the bat, we'll question, why is there so much cash on hand? Could they be doing something else with it? It falls a year later in 2000, and again in 2017. So it looks, it's looking to get better. Highest average cash ratio of the companies in the industry, though. It's just odd to have a company in an industry derived from inventory to have such a high cash ratio on average. I would think of more of their assets to be tied into receivables, making orders. But Constellation Brands, um, they've had an odd pattern of current ratios over the past 5 years. 2013, the current ratio rose to 3.6, which is way too high for almost any company around the industry. But never had a problem with short-term liquidity. But with the current ratio being so high, automatic thought process, of course, find a way to manage their current assets a little better. Can't automatically make the assumption though, because when we look at the quick ratio in the relation to the current, we see that the high current ratio came from large stockpile of inventory. Their cash ratios remain slightly comfortable margin for the past 5 years, unlike Boston Beer. So the company had a little too much cash on hand, just to be comfortable with up here. But Molson Coors Brewing Company looks to be at the bottom of the barrel when referring to short-term liquidity. The current ratio hasn't gotten above 1.0 for the last 6 years, so this company is not even solvent. So moving on. Long term, right? Yeah. During this period, they've had a steady level of financial leverage and have not shown any weakness in covering the debt, just with operations at least. So, as shown in the EBITDA, at least right here, this good little guy. But Boston Beer Company has taken on relatively less financial leverage. Excuse me. And it seems that no data could be gathered on whether or not that they could cover the debt, which is kind of weird. But Constellation Brands has taken on higher financial leverage than both Craft Brew Alliance and Boston Beer, and can cover it with operations pretty I guess efficiently. Uh, more likely to be Craft Brew is more likely to be able to weather the storm a little bit better than Constellation when comparing the two. But Molson Coors has taken on no more debt in the past 5 years, and it looks to be able to cover it. But the short run is just where we ran into problems, and they're not liquid enough to keep up the short run. So in the long run, EBITDA to interest is likely to get worse as the years go on. This may maybe a recipe for disaster, or I completely have it backwards. You never know. But moving on to asset management. So Craft Brew Alliance's asset turnover was pretty consistent. It was above 1.0, but Constellation and you know Constellation and Coors have had asset turnovers that are quite not quite as desirable. Wait, is it? There's Constellation and Coors. Pretty small margins, um, but Constellation's been able to produce better profit margins. Um, so if Constellation was better able to produce profit margins, it's a good signal of profitability. So it's not too bad. But alternatively, we have Coors with a low asset turnover and lower profit margins, and which I don't believe to be too much of a good sign, because these companies need assets to generate all their sales. But now we can look at ROE for all these companies. And when we look at Craft Brew Alliance, we see a pretty low trend in return on equity, at least compared to the other three companies in this presentation. The closest it comes to is pretty much Coors. But Boston Beer and Constellation have pretty good returns on equity. They when we look at market value, we can see that Boston Beer is going to be the most expensive to purchase, uh, because their price to book has been considerably higher than the rest, which can mean that it's going to be more expensive to the market when it comes to a purchase. Coors is going to be the company that's priced right where it comes to terms of price to book. Here, it has the lowest PE ratio of all the other companies, with Craft Brew Alliance right behind them. And the market seems to find Coors the least valuable by looking at the price to earnings ratio. So it seems to be fading towards the end here. But so that's that is the adult beverage industry. Um, as far as the winner is concerned, I would have to say Boston Beer. Uh, their return on equity is really it's consistent, and profit margins are okay. They're not the best. They're not the best. It's just that I'd rather this, as far as weights are concerned, profit margin and financial leverage uh is pretty. That's pretty good distribution in the return on equity for Boston Beer Company. So now we can move on to the retail industry. So when it comes to the retail industry, we have companies including Costco, Walmart, Target, Best Buy, and Sears. Uh, the retail overall is just selling products, and I just brought the biggest companies in here. At least Sears, once one of the biggest retailers out there. Um, all with different business models. We got wholesale and wholesale retail, just regular retail like Walmart, Target, upscale retail, Best Buy, technology retail, and Sears is all around retail, just not groceries or stuff like that. They do a lot of appliance stuff and like lawnmowers. So we're gonna look at these ratios a little differently, like asset management and solvency ratios. But Costco has shown that they can manage their short-term debts by having their current ratio closer to around 1.1. They've taken on more debt and financial leverage according to their total debt ratio and equity multiplier. And I'm okay with these levels of debt because according to their times interest earn ratio, they've been able to handle their debt, all this time pretty substantially, going from 55, ranging from 55 to 50 in the past 5 years. Excuse me. I can also see that their asset efficiency is pretty steady with turnover of inventory, and it's staying around 11. Total asset turnover is from 2.5 to 3.5. So we're good with that. But according to their profitability ratios, we see a consistent increase in returns on assets and equity, along with their profit margins. Their PE ratio is rising as well, so probably going to get a little overvalued in the next year or so, or it has been overvalued in the past year or so. But yeah, here we go. Walmart. Walmart's solvency doesn't show much promise in the short run solvency category, but with their current ratio, not even to 1. But Walmart is very efficient in turning over inventory and assets with sales. As you can see with these asset management numbers, they have been able to cover their debt for the long term, but their times interest earn ratio is significantly less than that of Costco's, at least. But according to their asset management, their ratios, they seem to be able to turn over their assets quickly with sales. Large portions of assets are in the inventory, and we are okay with that because of their return on assets. That's a nice number. They're still making a profit with the large stock of inventory, so it's good. With that's kind of pretty much how they run their business, is out of inventory, and they provide discounts. But with a quick asset turnover, they're able to generate a small and quick profit margin with each sale. You see, smaller numbers of profit margin, but like you said, they're able to turn over everything so quickly that it builds up so fast. But their PE ratio is rising as well, so it will be less. It's less expensive relative to Costco. Target has manageable short-term liquidity, but has tied up in inventory like all the other companies. Target has their financial leverage at the same range as both Walmart and Costco, which means that these three companies have the same leverage risk, kind of, if you think about it. Their operations are able to cover their bills. They generate sales efficiently, at least their assets, according to their total asset turnover. For profitability, they seem to keep the highest average profit margin of all the companies in this presentation, which means more ROE is driven by profitable sales for the company. And they also have the lowest PE ratio of the companies in here, at least for average. So now we go to Best Buy. On average, in the last 5 years, they've had a lot better liquidity than the other companies in this presentation. I feel like it's very important to have some really good liquidity if you have these heavily inventory operated stores. In 2017, 2018, Best Buy had relatively equal amounts of profit margin and total asset turn. Oh, excuse me, profit margin, total asset turnover, and equity multiplier in their ROE. So as you can see, we got a 3 ratio, we got a 3.1 ratio and a 3.2 ratio. These are equal distributions for making and leveraging money, and all of it going, all three of these components go into ROE, and it's a pretty average distribution of threes here, and I think it's a good weight. It's a good weight for ROE. So the PE ratio on average hasn't been anything to brag about, but it's close to both Walmart and Target's PE ratio. All right, so now here we go with the long-lived Sears. Okay, I've only heard bad things about Sears within the past year or so, and I wanted to look at the company to see why it's at its near end. So when it comes to short-term solvency, I don't see much of a difference from the other companies in the presentation. And then we go to the long-term debt ratios. We go to long-term debt ratios and find that the total debt ratio is rising, year by year. And then we see that their equity multiplier is negative. Whoa. For the past 3 years. And then their times interest earned ratio is negative. So they're negative in operations, for all these years. And lastly, all of their profitability ratios are either negative or just not existent. And with all negative earnings per share recorded with, between the past 5 years, there is no PE. There's no PE able to be pulled from Bloomberg. So, as a winner, I'm picking Best Buy. You will see a sell side report on Best Buy. All right, thank you.